Hi everyone, I'm very pleased to welcome you today to today's ERCC AGM. And of course, our repo and collateral work led by the ERCC remains one of the key pillars of ICMA. Once again, we're in virtual format. The plan initially obviously was to meet in Brussels around the Euroclear conference, but unfortunately that hasn't happened. Hopefully for the next general meeting in autumn, we can ultimately finally meet in person again. And within the ICMA construct, we're already beginning to roll out a lot of in-person engagement around the board meeting. And clearly we have the ICMA AGM in Vienna in June, which again, we're hoping to have a large event, which will be very successful. A very interesting agenda today, which certainly gives an impression of the breadth of the topics covered by the ERCC. And I'll leave it to Gareth to go into more detail on that point. One thing to note, with so much going on, not everything can be covered in the 2 hours that have been set aside for the meeting. So the agenda will be very focused. And as for previous events, already instead there's been recorded a number of webinar style updates on other key topics of interest and initiatives that couldn't fit into today's agenda, but hopefully they have been sent round. Hopefully you've all received those with the joining instructions, and certainly I would encourage you to look at those updates to get the full picture, many of which of course you are very much involved in on a day-to-day basis. As mentioned, repo and collateral is one of the key pillars of ICMA alongside primary and secondary markets, and strategically, we want to continue to build on existing and new areas, be that on the sustainability breadth that we have to reinvigorate and initiate our position around fintech and digitalization, again, where we already have a strong proposition. D&I, we're very keen to bring that more to the forefront of what we do, how we operate, how we're perceived by the market, and how we can help to frame market participants' behavior going forward. We're doing podcasts, we're bringing this more to the fore in the AGM and through publications such as the quarterly report. Our education program is already very strong also. We want to build more on that to really help the market training and development across all regions. And on the buy side, I still think, again, there's more work we can do to balance the membership of ICMA and bring in more representation from the buy side. Obviously, we're seeing that within the repo space as well, and I know that's going to be featured today. But away from that, in the buy side, we're bringing more integration around the primary markets discussions, and also in Asia, we feel that there's a lot of potential for us to continue to deliver a primary and a buy-side proposition within that region. I think it's also too important to note topically right now as well, we are monitoring closely the impact of sanctions on Russia and Russia-related entities on the repo and bond markets in particular, and ensuring that the relevant regulators are aware of any operational or market efficiency issues. You may well have seen on our website just last week, we published some considerations for the repo and secondary bond markets. We'll continue to develop on those thoughts and look to help with frameworks and guidelines as the situation becomes more clear. Finally, let me spend a minute just to introduce the 2022 ERCC committee, which was elected earlier this year and announced in early February. I think you can see that on the slide right now. As in previous years, the elections were again extremely competitive. I'd like to thank all of the candidates for standing in the election, and also all of the members who participated in the voting process. It's encouraging to see that the voting for this committee remains so strong, and it certainly shows the standing and the credibility of the ERCC in the market. Clearly, as mentioned as well before in previous fora, we want to build on that, create more of an international forum where we can start to bring in other regions and create more relationships across the different markets. We look forward to developing on that in the course of this year and next. But as a result, we again have a very strong committee. It has become more diverse over the years in terms of institutions, although there's certainly work that we can do in terms of the gender diversity, which I think has already been highlighted and is something that we can look forward to developing on in the future. And I also take the opportunity to congratulate Gareth Allen and Emma Cooper on their re-election as chair and vice chair of the committee. But with that, I'll hand over now to Gareth himself, who can run us through the agenda in more detail.
Hi everyone, welcome to our spring ERCC AGM. So nice to finally see the sun again on the way to work and going home. We've had a volatile start to 2022, what with the terrible invasion of Ukraine, knock-on effects to market volatility combined with global inflationary pressure triggering faster than expected exits from QE. This has certainly not made it a quiet first quarter. But it's really good to be introducing our AGM today. We have a panel discussion on challenges in the funding markets for the buy side, hopefully a great insight into what's on their minds both now and in the future. We'll finish with a short focus session on digitisation and repo, looking at the common domain model, which sets the future for interoperability of infrastructure and systems, and then also some of the ongoing work to digitise a standard clause library for the GMRA to make negotiating and agreeing the standard repo agreement much more efficient. But to kick off, we're really excited to introduce Klaus Lerber as our keynote speaker, who is the chair of the CCP Supervisory Committee at ESMA. So sit back, enjoy the meeting, and take care. Over to you, Klaus.
Thank you so much. And it's a great pleasure for me to join you again. And a big thanks to Brian and to Gareth for having invited me. So I just realized it has been quite a time since I joined last the ERCC, and certainly I have not joined you in my new capacity, which is a shame because by now I have been more than 18 months in my new role as chair of the CCP Supervisory Committee at ESMA. And of course, given the common interests that we have, it is really now a very nice opportunity to actually link up with you again and also to share with you some of the activities and focal points of the work of the CCP Supervisory Committee. I must say, I could have thought about easier new roles than taking up an entirely new function, building it from scratch in COVID lockdown. And it's now only 8 months that I actually have physically taken office in Paris after having worked previously remotely. Again, if somebody would have told me that this period is actually covered by 2 major crises, first the impact of COVID and now the implications of the deplorable Russian invasion of Ukraine, again, I may have reconsidered. However, it's perhaps good to share with you briefly actually what the CCP Supervisory Committee is about, because it may not be as transparent and clearly it's not as known as other supervisory bodies in the European Union like the single supervisory mechanism. So as you may be aware, there was a major reform of the legal framework for CCPs in the EU called EMIR taking effect in January 2020. And as a result of this reform, a new body was set up, the so-called CCP Supervisory Committee, which was certainly inspired a bit by the experience with the SSM, but it is a quite original setup because unlike other bodies, it is covering only a subset of national authorities. In this case, the national competent authorities of those jurisdictions which actually supervise an EU CCP. These are currently 12 jurisdictions out of the full range of the EU countries. And beyond this, however, we also incorporate the relevant central banks of issues for currencies that are of major relevance in EU CCPs. And we also have, apart from myself, 2 independent members to have a more holistic view on the CCP and the clearing segment represented in the committee. The committee actually has a wide range of new tools and measures and mandates. Again, quite interestingly, it is covering not only EU CCPs, but also third country CCPs to the extent that they are serving the EU markets and EU clearing members accessing their services. So from that perspective, let me just point out perhaps 2 or 3 relevant aspects to you. First, as you are well aware, CCPs have implications beyond a single jurisdiction. They not only concentrate risk, but they also distribute risk to risk mutualization, thus affecting potentially all jurisdictions in which major clearing members are located. So in recognition of this, first from an EU perspective, the Supervisory Committee has a quite central role looking at the activities of national supervisors. We are reviewing key decisions of national authorities, such as authorizations, extensions of service, or outsourcing. We are also validating the risk models. And again, in the follow-up of the experiences of COVID, and now also what we have seen in the commodities and energy markets, of course, this is a very relevant aspect to make sure that the risk management of CCPs functions smoothly and effectively. We have also a more comprehensive consolidated view across CCPs. And again, that is something which is quite unique. We are looking not only at the 14 CCPs established in the EU, but also include in our risk analysis major offshore CCPs, in particular London-based CCPs. All these are covered in our regular stress test exercises, which have evolved over the past years. They are actually now covering a wide range of key aspects, not only credit and liquidity risk, concentration risks. We have in the recent exercise, which will be finalized shortly, included a new segment on operational risk. And going forward, we may also cover further segments. One under consideration is climate risk, and I spend a second on this in a minute. But again, we are trying to make sure that we learn from experiences. We have our current peer review exercise, which is looking at activities of the national authorities, being dedicated to looking at the particular approaches taken by CCPs by remote working arrangements. Again, that is a lessons learned from COVID to focus on these particular aspects. But going forward, there are a few aspects which may be of interest to you. We have currently, for example, again, driven by the experiences of some of the peaks. We have seen the margin spikes in March and April in the onslaught of COVID in 2020. We are reviewing the existing anti-procyclicality tools under EMIR. And what we want to make sure is that there is appropriate functioning of the existing tools, that there is not an excessive procyclicality spike in the margins, and if so, we may need to take a look whether there is a need for certain adjustments. We had almost finalized this exercise, but now, of course, we take a further scrutiny to look at whether there are further adjustments that may be warranted in view of the commodity market events following the Russian invasion. Going forward, perhaps, just to give you a sneak preview on our focus going forward, we are focusing on emerging risks. And cyber risks are amongst those. Climate risks are already mentioned. We are actually just finalizing an open consultation on some elements of climate risk that we may consider of relevance, not just physical risk, but also business model risk, collateral replacement risk going forward, shift away from prone assets, and of course, generally transition risks that may affect the clearing space. Again, this is something that is looked at closely and going forward, and I have seen you have a panel also looking at innovation aspects, something which is very dear to my heart. We are, of course, also looking at the impact of new technologies on services and the CCP segment more generally. Again, there's quite an array of developments that may have a bearing here on risk management, on access, on the way the clearing and CCP space is designed more generally. And again, you will be aware there is a lot of discussion on some new entrants in this space like FTX or Binance offering innovative models in the crypto derivative space. But as I said, we are not just looking at EU CCPs, we are also looking at third country CCPs. And here, this is of course a reflection of the potential systemic implications that CCPs in third countries may have on the financial stability of the Union and its member states. And we do so in a proportional manner. EMIR obliges us to tier third country CCPs according to their systemic relevance. We currently have reviewed more than 30 third country CCPs that access and offer services to EU clearing members. And as a result of this, we have also reviewed our existing memorandum of understanding with third country authorities to enhance our ability to obtain information, to cooperate, and to react, if need be, to adverse developments. This is key to understand properly global risks, market developments, and also the impact of regulatory changes across the board. Just to flag that a number of you have, of course, followed very closely the discussion around the role of the London-based CCPs, which, of course, as a result of Brexit, has shifted two of the dominant CCPs serving the EU markets offshore. And this is reflected by the fact that in this tiering, we have categorized two CCPs, namely LCH Limited and ICE Clear Europe, as falling into category 2, which requires enhanced supervisory attention. These two CCPs are actually directly supervised by ESMA and the CCP Supervisory Committee and subject to an ongoing compliance with the EMIR requirements. There's a debate going on, and I will touch on that again in a second, about how the future framework should look like and whether it is sustainable to have this high degree of reliance on third country entities for the EU sector going forward. And one exercise that we had to conduct in accordance with the EMIR framework was to conduct a thorough and comprehensive technical and risk-based assessment of the risks emanating from the current situation and the particular dimension coming from the tier 2 CCPs. We actually looked very closely at the various aspects, the implications for the EU as a whole, individual member states, particular market segments. And as a result of this exercise, which was purely driven by risk considerations, we have determined that 3 services, not the CCPs as a whole, but 3 services are of substantive systemic importance to the EU. And these are Swap Clear for the Euro and Zloty segment, and ICE Clear CDS and short-term interest rates segments. These services are of such substantial systemic nature that the existing EMIR framework may not suffice, despite our direct supervisory powers, to contain adequately the risk that they may pose to EU financial stability, so further reflections are needed. The current situation did not warrant what was an option to revoke the recognition of these services, but clearly there is a need for further actions, and this is currently being discussed as part of the Commission's initiative to have a targeted review of EMIR. But let me focus a second specifically on the repo aspects. And again, I do not need to explain to you the particular relevance of the repo markets, but in ESMA, we of course look at a variety of aspects. Let me focus more specifically on the direct implications for the CCP Supervisory Committee, which is first the central clearing of repos and the increasing share of the EU repo markets that are being cleared centrally. And second, on the reliance of EU CCPs on the repo markets for certain of the activities, in particular cash reinvestments. We have, of course, seen the shift to central clearing, and we currently have the situation that 6 out of the 14 EU CCPs offer repo clearing services. Conversely, on the securities lending side, we have not seen a similar trend. Actually, of the 2 CCPs who had an authorization, one has given back its license to clear securities lending transactions. So clearly there's a disparity on this, but overall, when it comes to the repo segment, of course, we note the high percentage, around 70% of the transactions being centrally cleared, which, as you know, if you look more closely, is a very diverse picture. between the short term, in particular the one-day maturity, compared to the longer 10 years. Perhaps just to flag 3 points of attention, because currently in the Supervisory Committee, we look at 3 angles more specifically. One is the evolving nature of the clearing participants, where the traditional role of banks offering and participating is slowly evolving, and we are looking at the increased relevance of investment funds, money market funds, insurance companies in this segment. The second is to look at the development of new access models for clients. Again, this is something where we see quite a number of considerations and also some very innovative features challenging the current existing and dominant intermediation model. And lastly, we are looking at CCPs as users of repo services and their reliance on functioning repo markets. And also, of course, in this respect, there is a certain interaction with the offering of services by central banks, which is well aware. So perhaps just 1 minute going forward. Beyond these points of attention, let me perhaps share 2 or 3 reflections on the ongoing targeted review of EMIR and what it may bring, because again, that is something which is a consequence partially of the findings of ESMA on the degree of risks emanating from third country CCPs, the UK CCPs in particular, but also coming from more political considerations around the single market to increase the attractiveness of the EU financial markets and the clearing space in particular. ESMA's role here is clearly focusing on the risk dimension and the risk posed by the current elevated exposures to UK CCPs. But we very much welcome the very wide approach taken by ESMA in this respect in their public consultation and the open approach to look at a wide diversity of potential elements that could have a bearing here on, in particular, reducing the risk perspective. We are at ESMA have provided also our own views. There is a response which those of you who are more interested in the details are very welcome to take a closer look, in particular to look at whether certain prudential treatments of clearing members or exposure reduction targets may be useful tools or not, whether there is a role that could be played by active second clearing account requirements or a combination of certain aspects. But what is key from our perspective is to have a thorough assessment of the risk and benefits of each of those potential measures or combinations thereof. One particular aspect that we are taking a very close look is that there is not a creation of unlevel playing fields for EU participants, and also that any measures may not lead to a shift of activities not to EU CCPs, but to other third country CCPs which are authorized to provide clearing service to the EU. The last element, and then I'm happy to stop and see whether you have some particular questions. Of course, for us at ESMA, this is closely correlated to the question of the adequacy of the existing supervisory framework, and to have a robust and resilient supervisory system in place in the EU. Clearly, if there's an increase of the systemic dimension of EU CCPs, in particular the risk profile they may have as a pan-European dimension, this may necessitate to look whether the current setup is fully adequate. Also, despite all these reflections, there may be a need to take a closer look at whether some targeted improvements may be needed both in the EU and in the third country CCP supervisory framework. But again, this is part of the current ongoing discussions in the Brussels fora with the Parliament, with the Member States, with the Commission. So with this, let me stop short, and I'm looking forward to our future engagement, and I'm sure we will have further points of contact between the ERCC and the CCP Supervisory Committee.
I'd like to thank you for your insights into the structure and the workings of the ESMA CCP's Supervisory Committee. Clearly, CCPs are an integral part of the repo and collateral ecosystem. And as you say, I think we should definitely look to build closer ties between the committee and the ERCC. And we look forward to engaging with you a lot more in the future.
Many thanks.
Thank you, Klaus. What we'd like to do now is turn our attention to a very important topic that both Brian and Gareth mentioned in their opening statements, and that's the role of the buy side and the participation of the buy side in the repo market and the challenges that many buy sides face in accessing the repo market. And I'm delighted to be joined by a panel of buy side repo experts today to lead this discussion. Hi, thank you all for joining today. I'm delighted to introduce firstly Vanaja Indra, who is the Market and Regulatory Reform Director with Insight Investment. Charlie Badran, who is Head of Financing with AXA Investment Managers. And Rolof van der Stroik, who is Manager and Senior Investment Analyst with PGGM. Thank you again for joining today. Before we get into the meat of the discussion, one of the things that I think is always worth mentioning is there's generally a temptation to, when we talk about the buy side and their participation in the repo market, there is this temptation to view the buy side as this homogeneous entity. And this overlooks the fact that buy sides are different. Every investment firm is different. The underlying funds are different. The strategies employed by those funds are different. And therefore, the way in which investment firms access the repo market or rely on the repo market is also incredibly varied. And I think it would just be good to start off, maybe in turn, just giving some flavor of how you interact with the repo market, how important the repo market is, and the different ways in which you rely on it. Charlie, you're most prominent on the screen in front of me right now, so I'm going to start with you.
Okay, thank you, Andy. So I'm Charlie Badran. I'm the head of AXA Financing at AXA Investment Managers. So in charge of the repo activity globally, and especially on behalf of not only funds within AXA IM, but also on behalf of AXA Insurance Company. What we do and how we use the repo market. So we use it first for reinvestment purpose, so reinvesting cash for our money market fund. We use it for collateral management. We use it also for some leverage strategies, and to manage our duration gap for some insurance company.
Thanks, Charlie. So that already gives a sense of the multivariate ways in which the repo market could be used. Vanaja, could you provide some color on the way that Insight accesses the repo market and why it's important?
Yeah, sure. I mean, I think it's not, I don't have a lot to add from what Charlie said. It is, for all the usage of liquidity management purposes on behalf of our clients, whether it's pension funds, insurance companies, or other institutional funds. I think the key thing to note is that it's important for buy side from both sides of the book, both as cash investors from our money market funds, as well as those that may need liquidity. For example, some of our clients may need that liquidity to manage either margin calls or particular liquidity management that they may be facing at that time. And I do think the repo markets play a very important role in terms of oiling the system, ensuring that liquidity is passed on from those that have cash to those that need it, particularly in stress condition. So, I think it's a very important market for the buy side.
Thanks, Vanaja. Rolof, why is the repo market important to pension funds?
That's one of the major tools we use, of course, for managing the liquidity of our clients. They are basically, of course, cash long, or they're long the assets. So, but we use money market funds. We buy T-bills. But repo, of course, is very, very important for us in transformation. As I always say, when the sun is shining and the world is a nice place to be, nobody wants cash. But when the fertilizer hits the air conditioning, suddenly everybody wants cash. Apparently, we need a mechanism that's called repo, I believe. We do. I think also maybe good to mention the types of repos we do. We do repos and reverse repos. We do them bilaterally. We do them in tri-party, and we do them at 2 CCPs. We do them at the Eurex and at the LCH CCP. And there we trade baskets. We trade single license. So yeah, a lot. To give you some indication of the size, I think at the moment I have north of 6 billion outstanding in the repo market. Yeah, so that's, I think it's. If you see, we need quite a substantial amount of weak liquidity to make sure that we can fill our collateral pledging and everything. And so we need the repo product to function at all times to be able to fulfill that function.
So it sounds as if there are not only lots of different ways in which different firms need to access the repo market, use the repo market, but you've all touched on it, the importance of liquidity, the importance of being able to access the repo market. And Rodolphe, you mentioned the point that sometimes it's sunny, sometimes it's raining. It would be helpful to get a perspective on some of the challenges that you face accessing the repo market, whether it's a rainy day or a sunny day. Perhaps you could shed a little more light on this. Rodolphe, we'll go to you.
Well, of course, the rainy, shiny part is interesting, but also, of course, some reporting periods like year-end, quarter-end tend to create havoc in the market. As I'm saying, I mean, I could have a balance of 6 billion outstanding now, but towards year-end, that would not be possible because the market just isn't there. So I will have to decrease my liquidity and buy more T-bills or invest in other products at that moment. So that's a major challenge. IT, STP, transaction settlement and admin, of course, are quite major investments that you have to do to get repo working. It only works well if you can do it quite STP in quite an STP way, especially now with all the regulation, of course, like SFTR and these things. You cannot no longer can you book manually. You need these things to run into your systems STP and to be able to report according to SFTR and not fail being hit by CSDR. So there are some. Then of course you have the legal paperwork, which is still quite significant. Then of course the daily market to market. I mean, you need to exchange collateral. And as I touched, the regulation. It's you have to. There's quite a list of regulation that you have to comply with, which is quite a burden for companies like PGGM, and we are large, but we're not a bank. And then I always say we have a Dutch expression that says that we are a little too big for the napkin, but we're not quite large enough for the tablecloth. And I think that's so for us. These are quite large expenditures make this work.
It sounds as if there are a lot of hurdles. I mean, one alone would probably be something to think about. But
and then we have quite a size. I mean, then we have 260 billion in assets under management. I perish the thought that you are smaller.
Yeah, I think maybe depending on the size and how you are considered by the broker dealer, if you are tier 1, tier 2, and I think your access to the repo market is not I would say the same, and it's relying or dependent also on the quality of asset, and also if you are considered as a tier 1 or tier 2. So the access is not I would say entre guillemets fair, or should be acted as a partnership on the longer way, where the buy side should have the discussion with banks, and banks should be also stable on reporting date and also on quarter ends. And this is something very, I would say, crucial and very important for us, by having, like a partnership with the main broker dealer in the street, in order to be, to be able to have the capacity needed, of course.
That raises a really interesting point about intermediation and how critical that is. I mean, Vinaja, would you agree that intermediation is one of the biggest challenges, and the reliance on banks?
Yeah, no, absolutely. I mean, I think the buy side almost entirely relies on the bank for intermediation for repo market access. I mean, of course, there are peer-to-peer repo solutions out there, of which we have been quite active on, but I think we'd be all kidding ourselves if we thought that could in any shape or form compete with the banking intermediary. That is the most important access point for buy side to access the repo market. And I think the key challenge there, unfortunately, is that the buy side are at the mercy of banks' balance sheets and RWA constraints. We see the banks as playing a very critical role in terms of intermediating between the central banks and the rest of the market to ensure that liquidity does flow through even in stress conditions. And I think, to be honest, it's not just us who perceive that role. And when we've spoken to policymakers and we've said, the repo market's really important, it's got to stay robust in a stress condition, they've also come back and said, well, that's what the banks are there for. They have central bank access, and they're there to intermediate these markets and ensure that liquidity flows through. But I think, unfortunately, in stress conditions, that's not the reality of how things function, because banks, quite naturally are constrained by the banking rules. And particularly in a stress condition, they'd be more inward-looking to protect their balance sheet or RWA, whatever is binding constraint for that particular entity. And I think that's a shame, because it's a shame that the construct is that way, where effectively the system expects banks to play quite a role in terms of servicing the market, but at a time when things become a crunch, that's when that role that they play is really tested, and they may pull back from that. And that I think is a real concern for the buy side, particularly as we would expect volumes. You could argue that volumes demand could increase in the future as more buy side enters clearing, either voluntarily or as some of the exemptions fall away, like for European pension funds. So I think the intermediation model is really important, and unfortunately there are quite a lot of weaknesses there as things currently stand.
I think as well, you made the point about stress conditions. It would be interesting to hear from all of you on, if you can think back that far, your experience of March, April 2020, and how you found the intermediation model then and bank behavior. I don't know who wants to take this first.
Yeah, I'm happy to go first. I mean, I think, just to follow on from what I said, I think from our perspective, in terms of March 2020, we saw really increased volumes. There was a clearly greater demand from clients in terms of demand for cash to meet either margin calls or other liquidity needs when they didn't necessarily want to sell out of their asset holdings, which was also tanking in asset prices. So they preferred to go to the repo market to raise the cash than liquidate asset holdings at depressed prices. So there was definitely an increase in volume. Practically and operationally, we found it very cumbersome, very operationally intensive. I think on both sides, buy side and sell side, it was a very manual process to get that volume of trades going through. And that was, and I guess we have to remember that we did all just go to working from home overnight during that period as well. So that was quite an exceptional period. But operationally, it was, I think the market was challenged. We ourselves didn't have any issues in terms of raising cash, but I think there were issues in the market. And, Andy, I think the ICMA paper that looked at the March 2020 experience is really important because it highlighted the issues, some of the issues that buy side had. And it talked very clearly about the demand from buy side outstripping the supply provided by banks, and how banks were limiting access to their top tier clients. And there was a lot of banks that had shrunk their balance sheet capacity, even though some did increase it. It's not clear that they necessarily increased it to the buy side, and certainly not the directional players, which is where I think the pinch point could come from. So I think it's an interesting experience for all of us.
Yeah, maybe to add or to complete on our side, what we've seen is as you mentioned, some divergence between the banks. As you said, bigger banks increase their balance sheet, but on the short tenor, and they were not providing liquidity as usual in a sunny market, as Roloff say. So I think the solution or what we need is in times of stress, we need more liquidity, and the banks should be present and should be here by providing the liquidity that not only tier one needs, but also other buy side. And this is, I think, keen for the buy side community, because in a stress period, this is where we need the liquidity, and if the banks do not provide it, it's and it happens for some smaller buy side. It's something keen that banks should be aware of, and should also do that transmission of the liquidity from central banks. So, and with the ECB intervention on the European market, we had it gave some relief, and this has provided I think more capacity, and the market was smooth and better functioning, even if we had like 2 or 3 weeks with some challenge and some I would say fails and settlement due to manual processes, as you mentioned.
Roloff, how was your March 2020
experience? The good thing, it was quarter end and not year end, so that makes a small difference. I think I still understand. I think the elephant in the room is that if this had happened in the last 3 weeks of the year, I perish to think what would have happened. I think we would have, and I don't know if you could imagine an elephant in the room on a stampede, what that would do for your furniture. I think that's the what you should be thinking. If this had happened in the last 3 weeks of December, I really shudder to think what would have happened. And I think one of the things, of course, is that the liquidity goes out the door around that period. But I mean, in all fairness, the whole year, the investment in repo at banks, I think, they've been disinvesting on this product. I think they see it as a costly product. It could cost too much balance sheet, and I think they've reduced the headcount and the seniority of their teams quite significantly. And I think that's what you're seeing. And that's the effect I did see in March. I think that you are left with not the amount of traders and the seniority in the traders that have seen this before and can quickly make sure that either balance sheets are increased or it's. I think.
No, sorry, Ronald, please.
No, go ahead.
No, I was going to just pick up on a point made about how it can be more difficult to get bank balance sheet for directional transactions rather than, say, to put it bluntly, it's probably easier to get liquidity if you're a leveraged relative value hedge fund than if you're a pension fund trying to raise cash for margin.
Yep.
Which I think is one of the great ironies of the.
No, and the funny thing is, I mean, even if you are willing to pay, you just some banks just say, I'm not giving you the balance sheet. Period. So I think that's very worrying. I mean, if there's a price, then then you can scream, shout, you beg or borrow. But I mean, but just banks are just sorry, we're closed. It's end of the year. Sorry. Well, 3rd of January, we're back for business. I mean, and it's not one banker. So it's.
No, it definitely sounds worrying, not like a healthy functioning market. I think where we'd like to take the discussion is perhaps to look at some of the solutions. Obviously, more balance sheets, more risk capacity from banks, particularly in times of stress, would be one solution. But looking beyond that, what other initiatives do you see out there that can help the buy side with in terms of access to the market? Charlie, I don't know if you want to kick off on that one.
So we have, I think we have different solution and different participant, like some clearinghouse and some banks which are, trying to have the buy side connected, as Roloff is already connected through LCH and Eurex with regards to his reinvestment, cash reinvestment as a cash reinvestment tool. And I think maybe this will help in a sense of, it will help more the banking community to net some transaction. And by netting the buy side transaction through the CCP, I think this will provide more capacity to the street, and especially to the buy side. If you look at the interbanking market, where 70% of the repo is cleared, and they are better managing their liquidity ratio and their leverage ratio through CCPs by the netting efficiency, and by adding buy side within the framework. I think that it will help banks to provide more capacity, because by netting the transaction, they will be it will be neutral with regards to the leverage ratio.
And let me give you another extremely important plus of central clearing, of course, is that I now suddenly have, by adding one counterparty, which did take a little time, I do admit, I now suddenly have 50 banks who I can deal with at the push on one platform. And of course, that's what I see at the moment. I think I did 3-4 billion in trades today with most probably 10 plus banks. So I mean, it's for me, it would be it's an indispensable, become an indispensable tool. So it's part of the solution, I think.
I think if you are looking for collateral today, it's and investing the cash, it's a tool that you are, I think you need to have today, because collateral in the bilateral market is really hard to find.
No, I was just going to say, I think there's three solutions that we wanted to highlight. Firstly, as Charlie and Rolf already mentioned, in terms of supporting buy-side sponsored clearing repo models, I think, as Charlie and Rolf has already explained, it's a model that I think every buy-side should be supporting. But I think more importantly, there needs to be more support from the banks as well. So there aren't many clearing members supporting this service right now. So I think certainly our ambition in terms of where it needs to be is far greater than the reality of the situation today. So we would love to see greater support from banks on the sponsor clearing models. Over time, we would also like to see the clearing houses change their rules so that it would be permissible for the medium-sized clients to also participate in these models. And indeed, I think the buy side also needs to adopt this more. We've been very active on this, but it would be good to have a diversified set of buy side also participating on this model. So that's on sponsored repo clearing model. In terms of two other points, I think there's some other thing that's worthwhile mentioning as well. We would quite like money market funds to be able to trade cleared repos. And I think that would be a helpful force of stability in stress conditions, with the money market funds can be the cash provider when the rest of the market may be needing that in stress conditions. And unfortunately, at this point in time, because of an anomaly in EU regulation, that's not permitted post-Brexit, at least in connection to UK CCP. So I think there's a little bit of work that can be done there to help. Thirdly, I know we talked a lot about banking solution, and it kind of sounded a little bit like moaning, but I think there's some work to be done there. And perhaps, I don't know if ICMA or the banking community are willing to sort of get together to try and figure out, okay, what are the tweaks that we can make to the banking rules? Like, what is the minimum amount of tweaks that would be needed in the banking rules such that we could confidently say we can provide liquidity to the buy side in stress condition? Because it's very difficult for us as buy side to have this conversation with the policymakers, because we don't know the levers for each bank. And I think it would be really helpful if the banking community could also take some ownership of this issue from the perspective of providing a service to the market that is very much needed. And I think central banks and policymakers want to see banks doing that. So it would be really helpful if we could get some study or something done on that to try and move that discussion forward. That was it for me. Thank you.
That's really helpful. And I'm going to stay with the sponsored clearing topic for a moment. One of the questions that's come in is would CCPs have helped during, or sponsored clearing, would it have helped the buy side during the stresses in March 2020? So that's going to be question number one. Question number two was, clearly there's a cost to this. Sponsored clearing isn't cheap. Does the cost justify the benefits? I don't know who wants to take that first. Charlie, I'm looking at you.
What was the first question? Sorry.
So the first one is, this has come from one of the delegates. Would sponsored clearing have made a big difference in March 2020?
I don't think so, because you had also even if you were connected to the CCP, you had a lot of fails, and also bank restricted the access through not only bilateral trades, but also through CCP. So the contraction were I think it was not linked to CCP, and not to balance sheet, but it was, I think, during the market of stress, everybody was not keen to provide liquidity. Same as we have seen in the US in September, I think 2 or 3 years ago, where for 2 or 3 days, market was not functioning well, and it was not even a quarter end.
Yeah, banks were not providing liquidity even through CCP.
So, Roloff, I'm going to ask you: Does the cost of sponsor clearing justify the benefits?
I'm going to say something that yes, it does. But I think it's never good in a market to force people to buy something that a monopolist is providing. I think we're being forced in a direction, and monopoly is being given to certain parties. That mostly doesn't improve the product that's being delivered. So I think that's the. But yes, it also saves me a lot of money. So I think net, I don't see it as an expensive increasing product. Once you've sunk you have the sunk costs paid, and I think it's. I think in this case, access to the market is more important than the possibly slightly higher cost. And to answer your question, in March, it did help us. It isn't the panacea but it did help us because you have an enormous diversity of banks that are on the platform, and there's always one somewhere that can help you with or needs something somewhere. So I think it does help.
So we've had.
But I think maybe one last. Sorry about that. One last thing. I think it maybe what also enormously important is the trading platform, because that's of course also lacking in the repo market. A nice, transparent, open marketplace where you can transact with tens of banks. When you're bilateral, you have a few GMRAs, and that's it. And if those 5 banks that day are not there, then you're up a creek and you don't have a paddle with you. And that's so. Yes, it did help.
You've anticipated my next question, which is based on some more of the Q&A that has come in, and it's precisely that: electronic trading, access to trading platforms. How would this help? How does this help transform liquidity? Does it make the difference?
I think electronic platforms will be helpful in terms of increasing standardization. And I think with the, when you combine buy side being on the cleared repo platform, if that's combined in a workable way with electronic platforms, then I think, that would hopefully increase the participation in the repo markets, and we'd have more players to transact with. And I think that's the end goal. I understand there's probably more work to be done on that front. But it is, I think, something that we should all aspire to in terms of making sure that we can tap into the liquidity when it's needed, particularly in stress conditions, so, so that we can access the repo markets. Thank you.
No, thank you. But Roloff, you mentioned earlier that electronification and using platforms, and I assume linking up with OMS, EMS, it's expensive, right? This is a big investment.
Absolutely. I think that's the point. I think, and there's 2 things, of course. When you're searching for liquidity, but in a stress situation, you don't want to spend a whole day booking trades with all kinds of manual processes and all the risk of. I'm very bad at booking trades. It's not my strong suit. So, but if sometimes I can if I can do something which is completely STP, then I can do smaller trades. So then somebody can say, I have 15 pieces of paper here, 20 million, 25 million, but I can give you those if I can book them completely automatically. It isn't a burden. If I have to book 15 trades manually, then and it's a stress time, then I say forget it. It's not going to work. So also their trading platform helps enormously, of course, but also transparency. I mean, I think it's so important in markets. I think good developed markets are transparent markets where there's price forming on a marketplace. I think that's so. Yeah, a few good trading platforms, standardized GMRAs, whatever. I mean, I think standardized tri-party baskets. I think all things we could do as an industry, but also all vendors of admin products. Make sure that the connectivity is all standardized, so that it doesn't take people months to suddenly be able to book an open repo, for example.
Charlie, great to have you back. We, as you probably realized, we're talking about electronification, we're talking about platforms, we're talking about transparency. If bearing in mind there's probably quite a few vendors and solution providers tuning into this, and we just had some good thoughts and advice from Fanaja and Marolov. Charlie, what would you say to any vendor trying to find a buy-side solution? Or advice would you give them? Or maybe hold that thought, and we'll come back to it. I guess one of the things that perhaps we should also think about, we talked about banks taking the initiative, and Fanaja made a very good point about maybe banks pushing the discussion around what they can do to improve their capacity and to be able to provide more balance sheet, and I guess more evenly across the buy-side community. And we talked a little bit about some of the possible vendor solutions or third-party solutions, standardization being a critical component of that. What can the buy-side do? What should the buy-side be doing to help their situation? Fanaja, I don't know if you want to kick off on that one.
Yeah, sure. I mean, I think on one hand, we should be supporting the sponsored cleared repo models more. So I think it would be helpful if more buy-side would adopt that model. I guess it has to happen hand in hand with more banks providing their clearing member services, sponsored clearing member services as well. But in the end, I think we want to have ideally a diverse set of users on the platform. What else? I mean, I think standardization will be helpful in terms of increasing liquidity, as we've already mentioned. So, perhaps there's some work that the buy side can do in terms of embracing standardization, which might not always be easy for some of the buy side. So I think that's something to think about as well.
Sorry for that. So in terms of electronic platform, I was saying that you have multiple vendors that are already acting within the fixed income market, within the cash market, and also some that are some vendors that are connected in the repo interbanking market. I think there is different solution, but each buy side or each repo desk has his own particular demand, and I think trading platform should adapt or should have the main functionality, but also should widen their scope in terms of open repo, evergreen repo, or multiple tenor request for quote, and to be able to have them on board. And also I think this will smooth not only the connectivity to bank, but as I think Roloff says, if you have 10, 15 or 20 trades to book, it will take you are wasting your time, and by having a trading platform on board, you will be it will be like a smooth process, STP straight to the back office, and you without having to book manually your trades.
Well, I'm going to use that by way of a plug for the next panel, which is going to focus exclusively on the solutions, automation, and supporting interoperability in the repo market and creating standardization. So obviously it sounds like there's still a lot of work that needs to be done there. Roelof, what do you think the buy side can do to help itself? Is it already helping itself?
Yeah, I think we should be prepared to invest. I think that's something at PGM we've been doing quite vigorously. It's a tough to get the budget for it. It is. I mean, if you're telling me it's an umbrella, but the sun is shining. That's we say, why do you want the umbrella? For the one in 20-year event, for example. So that's one. I think also maybe we should try to resist temptation in the sense that, I mean, if the regulator is saying, we don't like shadow banking, we want you to go to the CCPs, maybe we should then, not invest in peer-to-peer solutions. However much it feels, as I said, I mean, giving everything to monopolistic providers doesn't feel like a very good business case. But I think sometimes, we just pick your battles. Even though I would love to go to peer-to-peer platforms, or I would love to be able to open up to parties like, for example, we have a rather large US dollar hedge. I mean, wouldn't it be nice if I could just exchange liquidity with somebody at the other side of the pond who has exactly the opposing deals every day? It would make sense. Yeah, but I resist temptation and focus on what at the moment is there. So I think that's.
One thing we do hear more about is the peer-to-peer solutions. So, and you made a good point there, Roelof, that one could look at that with a regulatory lens and say, well, isn't that non-bank financial intermediation? Is that a problem? I don't know.
But they're forcing us. On the other hand, they're forcing us that way. So I mean, we are scared shitless that on one day we'll wake up and the repo market is dried up. So we're trying frantically to find liquidity. But we only have a certain amount of investment money to invest in new products. So I think it's what can we do? That's we invest wisely. Make our pocket count.
No, well phrased. So Venado, I mean, you mentioned peer-to-peer solutions. Is this something where you see any great hope for getting away from bank reliance?
I'm not sure that we're convinced that that's a solution to get away from bank reliance. I think it's something that you have as a second layer of protection. It is quite resource intensive to find those particular players, set them up. So it's not easy by any means, and you don't necessarily know that you'll have that liquidity there when you need it as well. So I think you definitely do that as a second layer of protection. But as I said earlier, I don't think it's something that we expect for it to replace banking intermediation. I think we have to remember that banks play a very unique role in this economy because they are the only institutions that have access to central banks. So if at any point central banks do want to pass liquidity through, it will be done by the banks, and that can't be replaced. So I would say it's an additional layer of protection, but not that will replace banking intermediation.
I realise that we've only got a couple more minutes, so I'm just looking through the various questions that have come in, and I think we've pretty much answered all of them. So I'm just going to throw out one last question, and it picks up on a point that you've made, Venancio, about the role of banks and their link with the central banks. Would direct access for buy sides to central banks help? Is this something that should be a consideration? I don't know who wants to take that first. Oh, Venancio, you're smiling.
I think you know the answer to that question from us. I do think it would help, but I don't think it needs to come in the form of necessarily clients. When we say direct access, it's not through the asset manager, it would be to the clients. I don't think, let's take pension funds as one set of clients, for example. I don't think they would need to be directly linked to the central bank, because that would be quite difficult for the central bank to manage counterparty risk and quite cumbersome. So I don't think it needs to come in that complex form. I think it could come in a form where the buy side has access to cleared repos, and therefore they can trade on a cleared repo platform and on a trading venue, and the central bank, let's say, is on the same trading venue and is able to direct liquidity to that buy side entity through that platform, which is then cleared. Therefore, the central bank would never face the buy side entity as a counterparty, so it wouldn't have to deal with all the counterparty risk element. So, I mean, I think the infrastructure is already out there, should the desire evolve in that direction.
I concur completely. I think I think the important thing is giving a bank's monopoly means that you either say to the banks, okay, you've gotten a monopoly, but now it's also your obligation to always be there whatever happens, or you say, in cases that it really goes wrong, we will step in, and then via the central clearing option, it's very easy. They're on the platform, and the only thing I would like to do is test it once or twice just to make sure it works, and then we know where to find each other. I think that's in normal conditions where it's great. We'll manage, but in exceptional conditions, either force the banks to be there, or provide another solution. That's the obligation of somebody who gives somebody a monopoly. It's no other than railway lines or whatever. I mean, if you give somebody a monopoly, then it comes with obligations.
I hear you. Charlie, any final, in the last minute, any final thoughts on the role of the central bank?
If we need to have direct access to the central bank, I think in a way, direct access to CCP is another story. If we have, the sponsors clearing model first working well, and then I think we'll have to see how we can move forward after that.
Thank you. That's definitely food for thought, and I think a conversation to be continued. By way of another plug, I'd just like to let the delegates know or remind them that on, I think it's May 11th, we'll be holding our second buy-side workshop, looking at many of these topics. This time we'll be joined by the sell side to explore some of the sell side, buy side dynamics that were touched on today, and some of the challenges facing intermediation. So if you are a buy side firm and you've enjoyed this discussion and you're interested in being a part of it, please do drop us a note. It's open to members and non-members. So it leads me to thank my panelists today. Vinaja, Charlie Roloff, thank you so much. That's been an incredibly informative 45-50 minutes, as I mentioned, to be continued in various formats.
Good afternoon and welcome to this focus session on digital repo and the common domain model for repo and bonds. My name is Gabriel Carlsen. I'm responsible for fintech across primary and secondary bond markets, repo and collateral markets, and sustainable finance at ICMA. On the agenda, we have phase 2 of the CDM for repo and bonds and a presentation by Clearstream on the implementation of the CDM. Now, we've heard earlier already from the buy-side discussion about the benefits of STP, the need for standardization and connectivity, in particular for open repos. And this is precisely what the CDM seeks to facilitate. Now, when we take a step back, digitization is impacting every aspect of financial markets, and repo markets are no exception. The CDM enables IT systems to speak the same language and facilitates your journey towards digitization when it comes to automation, but also when thinking ahead, whether you consider exploring distributed ledger technology, AI and machine learning, or cloud. Importantly, the CDM is based on a cross-industry collaboration between ICMA, ISDA, and ISLA. As a reminder, in phase 1 last year, we extended the CDM so that firms can use it to streamline and automate trading, clearing, and settlement of fixed-term repos. We are now launching phase 2 of the CDM, and the objective here is twofold. The first is to support the electronification of repo markets, in particular open repos, floating rate repos, and evergreens. This is based on feedback from ERCC members on the recent roadmap and through the survey last year. And the second objective is to promote adoption by raising awareness, but also by supporting firms who are looking to conduct a proof of concept or implement the CDM. So if you would like to discuss your CDM project, please get in touch. While best practices in the European repo market are reflected in the ERCC guide, market participants can choose between a broad range of vendor firms and internal solutions to translate repo workflows into their internal IT systems, whether for trading, risk management, or reporting, amongst others. This leads inevitably to divergence, manual intervention, and increased operational costs, even more so for complex repo structures. So the lifecycle events and processes that we're considering in phase 2 include reprice or re-rates, roll unwind, pairs of, partials, and shaping, amongst others. And in parallel, we are also looking to collaborate more closely with ISDA and ISLA on collateral-related processes to create synergies. Now, what's the benefit of using the CDM? On the one hand, you can reduce manual intervention and automate reconciliations in the middle and back office, since the CDM enables firms to view a transaction through the same lens. But the CDM also enables you to build and adapt internal IT systems more easily and to trade open repos electronically, as the CDM generates the workflows and code, so freeing up your software developers' time. And looking ahead, it also allows you to future-proof operations for new technologies, such as DLT, as well as evolving reporting requirements, for example, under the SFT regulation. If you would like to shape this initiative, you are invited to join the CDM steering committee, which will agree and prioritize deliverables and provide overall guidance. In terms of participation, I would encourage you to involve colleagues from your IT department, software developers, and data modelers, as well as legal and regulatory experts. Translating best practice into code requires a broad skill set. The first meeting will be held next Tuesday, 3rd of May, in the afternoon from 3 to 4 UK time. And then from the following week, fortnightly meetings will be held on Thursdays from 2 to 3 UK time until the end of July initially. The roadmap here includes the timelines and regulatory key dates. We will be separating the conceptual modeling, or in other words, visualizing the workflows from the programming or logical modeling to make best use of everyone's resources and cover more ground. The aim is to complete the modeling by Q4 and merge the CDM for repo and bonds with ISDA's version by Q1 next year. In parallel, ICMA, ISDA, and ISLA continue to work together on CDM governance arrangements. It is our aim for this year to transfer the CDM code to a third-party repository. We are expecting to launch an RFQ shortly. Now, looking at the regulatory dates, the review of SFTR was delayed from last year and is expected to be conducted in the second half of this year. Any changes would be expected to apply next year, but the scope and timings are somewhat uncertain. On the other hand, the revised rules for swaps reporting in the US, known as CFTC rewrite, will take effect in November this year. And ISDA has been working with a broad range of firms amongst our joint membership to build the reporting functionalities using the CDM. In Europe, EMIR refit is expected to enter into force next year. Now, an important question in relation to the CDM is adoption. How do you implement the CDM? Where does it fit in? And I'm delighted that Crispin Seal, product manager for derivatives collateral management at Clearstream, has joined us today. and will be able to share insights into Clearstream's CDM project. Chris, could you briefly introduce yourself and tell us a bit more about your involvement in the CDM initiative?
Yeah, hello. So yeah, my name, as you said, is Chris Sell. I've been working for Clearstream for 26 years, and I moved into the collateral management area in 2007, which was an interesting year for collateral management. Over the years, worked on a lot of interesting projects, and a lot of them specifically relate since 2007 have been related to reference data. I think reference data has evolved over the years. Actually, before I'm going to talk a little bit about CDM, because I think that, CDM covers many things. I'm not going to go through everything in this slide. This is a slide that was provided by ISDA as a useful introduction. And, I think there are parts of the CDM that are covering the documentation, the legal documentation, the messaging. And here we're talking about the eligibility criteria, which is really the interest that we have and what we're trying to implement at the moment. So I really want to talk about kind of how, the challenges that we've faced in looking at how we were going to do this, and why we've chosen the solution that we have. Now, as many of you may know, Clearstream started doing tri-party repo, which turned into collateral management in 1992. Now, I give this a historical context because, we started with repo, we expanded to securities lending and other exposure types. And we've kind of, recently the regulation has brought in derivatives collateral management into the process. Over the 30 years, which I would split into two, the kind of the data model that we have for our collateral management engine has evolved. So probably relatively slowly over the first 15 years up to 2007, and the subprime crisis hit, and the Lehman's crisis after that, and many different colors of those crises in the following years. And I think our data model evolved even faster after that time. Now, as well as the data model evolving, we've been onboarding customers. So we have a set of customers, quite a few customers, many people who will be on this session today. And they've signed documents based on our data structure. So, the legal documents which define the eligibility criteria link directly into the data that our collateral management engine uses. So now, we have that data model. Our customers probably have slightly different models. Our competitors, other tri-party agents, will have slightly different ways of representing the same data. And I think this is where the value of the CDM really comes in, because it's coming in as an impartial kind of comprehensive way of representing eligibility criteria in all domains. So the eligibility, haircuts, concentrations, so that everyone can interconnect their model in the same way. Now, going back to this history that I've given you, if we kind of tomorrow said, okay, everyone, we're using CDM, what that would mean is all of the criteria, all of the thousands of contracts that are in place would suddenly need to be repapered because we would be using a different model. Now, obviously, we're not going to do that. So we need a way that we can have our collateral management system that can support this new model without kind of forcing our customers to do changes in the first place. Now, as you can see, the picture on the left here, we have the picture of our collateral management engine. We have the different types of entity that are linked to us and the types of exposure that we deal with. Now move to the next slide. Now, what we've been working on in the last couple of years, and we'll be implementing later this year, is a kind of separate system which kind of partners with our collateral management system, and it's called OSCAR. And what it does, it will use natural language, so kind of normal English language, to and convert that into eligibility profiles. So basically a collateral giver or collateral receiver will go in, they will start typing in normal language what they want to exclude, what they want to include, what the haircuts they want to do. And the artificial intelligence and natural language processing will convert that into an eligibility profile that can then be downloaded and by operations and uploaded into our collateral management system and then used just like any other criteria. As well as kind of setting up the profiles, the system allows negotiation and agreeing of those profiles. So basically what we've got is a system that can do translations, that can communicate with our collateral management system to say what those profiles are, which brings me on to the next slide, is where we thought CDM can come into this process. Because if we link CDM into our OSCAR application, it will basically need to do the same thing that OSCAR's already doing with natural language, and basically convert the data structure that is in CDM into the data structure that is in OSCAR, that can then be read into the data structure that can be read in our collateral management system. So basically what this will allow is for people to do the negotiations fully in OSCAR and then export the format into CDM model. But conversely, they will be able to negotiate the criteria in CDM format. And at every step of the process, they'll be able to upload that format into OSCAR and have that validated to make sure that it will work in our collateral management system. For when they get to the final version with their counterparty, they know that that will work in our system. Now, I think the good thing about CDM is it's universal, but it's kind of building up from scratch. And I think the more entities that engage in this, the better. And I think we come in, we've already done a first stage comparing our criteria to what CDM has, and we've made recommendations of some of the features that we can support that they didn't initially, and that's already been updated in the model. And maybe just to finish off that, so we are looking to implement OSCAR later this year. CDM, we're already starting to look at how the model will work in the system, and we hope to implement that later in the year.
Well, thank you, Chris, for this fascinating presentation, which brings the concept of the CDM to life and shows the different steps in implementing the CDM. And I particularly take your point on providing a connectivity layer between the different data models that are, of course, specific to each market participant and enabling those to speak the same language. So we now have a few minutes left for Q&A, and I will open the floor to questions. Whilst looking at the chat box here, there are a few questions already. One here is, what were the main challenges that you faced in implementing the model?
Yeah, I think the main challenge really is to look at what was already included in the model. It started off, I think, aiming to cover the needs of the derivatives market with the view of expanding, obviously, to the other markets. And what we want to do straight away, we're a tri-party agent. As I said earlier, we cover all types of exposure already, and we're quite highly evolved. So we have criteria on different levels that can be applied. So it really is to looking at the flexibility of our system and say, how can that be supported in CDM? Now, the good thing is it as well as being a flexible model, it's very responsive. So, I think we're not the only one who's coming up with suggestions, and there are discussions in the various meetings for the CDM. So, if you come up with a new the way you're working in your platform management system, they're happy to look at that and then put that into the timeline for development. And I think the more that happens, I think the better the model will be, and the quicker it can be universally accepted.
Right, I think that seems to be a really important point, that the CDM is a flexible model that lives from the input that is provided by the community, by the users. There's a related question here. In terms of investment, does it require a significant financial investment for a big firm to be able to plug into the CDM? Of course, it's going to be difficult to give a precise figures, but Chris, do you have any views on this?
Well, I think really, there is time and effort involved in implementing this. It really is. I can't kind of detail the IT development figures, but it really is the process of mapping the data fields from one process to another, and the IT development is not that complex. It's just a mapping exercise, really.
Mm-hmm. Great. I think that probably answers part of the question. Then one additional question here is, what is your advice to firms who want to implement the CDM?
Well, I think you've got to see how the model can work with the way you use your data at the moment. Now, the way we've done that with adding this extra layer, that's one way of doing it. But you could also modify your data layer. But the key thing, I think, is the earlier you get involved in the process and the discussions on how the data model evolves, the more likely it is to fit into the way you're working. So I would suggest that people get involved in the discussions.
Great. I think that's a very important point, actually. Since we're going to launch phase 2, since we're going to hold the first meeting of phase 2 next week, there's also one additional question. Are there users already of the CDM for repos? And the answer is yes, you can use and access the CDM. There are a number of firms who have accessed the CDM, the Rosetta environment, which visualizes the CDM. But of course, the implementation then is a question for firms. Some have conducted proofs of concept, some are looking, like Clearstream, to implement it in production. So that's specific to each firm, but the answer here is yes, there are a number of different users and firms involved in this. Now, in the interest of time, we'll wrap up here and move to the next point of the agenda. Just as a reminder, if you would like to contribute to phase 2 of the CDM, or if you're interested in discussing a CDM project, please get in touch. And with this, I will now hand over to Lisa Cleary. Thank you.
Thank you very much, Gabriel. Great session on the CDM there, but we'll move on now to the GMRA clause taxonomy and library project. My name is Lisa Cleary, and I'm a senior director in the legal team here at ICMA. Today, I have the pleasure of introducing an update on the GMRA clause library and taxonomy initiative. The ICMA has fostered the development of the GMRA for over 30 years, supporting its function as the foremost agreement for documenting cross-border repo. Published as a standard form, it is of course subject to negotiation in order to agree commercial terms, but also to reflect in-house templates. ICMA has concluded phase 1 of its GMRA clause library and taxonomy project, aimed at streamlining document generation and negotiation processes and limiting the battle of the forms in the near term, as well as providing ICMA with an insight into documentation and market practice with respect to the GMRA. I am delighted to introduce Akbar Datu from D2L Technology, with whom we are working on this initiative. Akbar will present the work completed so far and outline potential next steps. If you do have any questions during Akbar's presentation, please use the chat function to the side of the screen. Akbar, over to you.
Thank you very much, Lisa, and thank you for the opportunity to present the work that's being done. I think maybe just useful to give a bit of background as to kind of how I have come at this. I mean, my background is as a technologist, and then subsequently as a lawyer. So I guess it's been a very interesting and I think very foundational step for the industry in order to try and embrace document digitization and the benefits that that might bring, and I hope to touch on some of that to give some context to everyone. So as has been detailed, the GMRA has been a core document in this industry. Although I guess the way in which it's been presented in terms of a preprint and then a sections that people will then negotiate and tailor in order to meet their requirements means that we need to really look at that and make sure that we are fit and ready for the benefits of digitization. And really we've got two things to think about. As market participants, we will have a portfolio of legacy agreements that they're stored in a legal agreement database. It might be shared folders. It might be printouts in a drawer. But essentially, those things are executed. They are there, and we need to concern ourselves with what's been agreed and make sure we give effect to it or understand those contractual obligations and what it might mean for us. There's also new agreements that are being put in place, both entirely new relationship agreements, GMRAs, but there's also amendments to existing ones that also need to be considered as part of it. And I think it's really important to bear in mind those two aspects of things when thinking through what digitization might mean and how it might help. This slide here really gives some background as to the process that we've gone through with this project that ICMA have sponsored and allowed us to assist with. I think one of the simplest ways of looking at it is to say that any agreement can be broken down into a series of clauses. And you can see, we've said, well, an agreement, let's say it's got 5 clauses in the middle there. And then each of those has a slightly different color. And what you can see next to it is some smaller circles of slightly different shades of a particular color that represent the clause, each representing a different variant or what that clause might achieve for us. Although you can see four variants in respect of each of those clauses, the reality might be that for a particular clause there may be more or there may be less variants of those particular clauses. I'll come back to exactly what was done and how this relates to the legacy and the new agreements. But just to give you a sense as to the work that's been undertaken so far, at the bottom there you can see that there have been 31 kind of core working group attendees. We've had 6 business outcome working groups that will make a bit more sense in a moment. 18 member entities that we've had take part, over 500 agreements reviewed, in excess of 200 clauses provided by members, and all in all, over 10,000 clauses therefore analysed in terms of getting us to where we are at the moment. And if we go to the next slide, I can go into a bit more detail around this, what this means. Now, the phase of work has concentrated on 10 clauses within the GMRA that were discussed with members and also ICMA. And you can see the list of those clauses there, ranging from transaction exposure, interest on cash margin, failure to deliver, automatic early termination, set off, margin call delivery period, designated office, business day, income payment date, and interest. And as I said, although it suggests here that there are just 4 variants, in reality, we saw more variants for each of the clauses, but that's not a set number. That's very much what we sought to determine through the discussions as part of our working groups. What does this mean? Well, for each of those clauses, if we're able to say that here are the different outcomes that one might negotiate within the GMRA for that particular clause, then we can look at our legacy portfolios, and irrespective of the particular style or formatting of drafting that might have been used, we can start to say, well, this particular agreement that we have executed actually utilizes version or variant 2 of the transaction exposure clause. That is the variant that gives us the outcome that we need to be concerned about in terms of managing our relationship with our counterparty. So what you can see there on the right-hand side is essentially a legacy portfolio. In this case, we're looking at 4 particular GMRAs. And although the wording may vary from every institution, and that's one of the challenges that we'll talk about, we're able to succinctly describe what it achieves and what it means to us. So in order to do that, we firstly need to define what we mean by a particular clause. And I think it's fair to say that although this might seem pretty trivial or straightforward, we've certainly seen some real world examples where firms have run into real trouble because even within an institution, that understanding of what we mean by a particular clause is not particularly well set. The example that I always like to give on that is when we talk about who the parties are to the agreement. Now that might, you feel, be set out at the very top of the agreement through the definition of the parties. But there are various details such as branches, offices that might be involved that might actually mean that if we're not careful, we might be talking about 2 different things. So the first thing that we did in terms of setting out on this journey was for those 10 clauses to put a starter definition for the clause out and discuss it as a group in order to understand whether it was appropriate, whether it was too tight, whether it needed to be expanded, so that we could very clearly be able to look at any legacy agreement, but also we're going to use this for the future as well. And if we're asked to say, where is this clause, we're able to very quickly identify the language that's relevant. And that's important so that we can deal with concepts such as split clauses, where a clause might be one particular paragraph, you might need to then turn over a couple of pages and see the rest of it later on, because that might have just been the formatting or the style in which it was dealt with. What we also set out that you can see in the top row there is the related clauses. And I guess this goes hand in hand with the definition of the clause, because we really want to understand what this clause is doing and how it sits, because it might interrelate with other key clauses or other definitions that might exist. We set up these working group meetings where we would discuss a subset of the 10 clauses, and essentially through a review of legacy agreements provided by members or that we've been able to obtain, essentially the process was that we tried to determine what all the relevant variants, the business outcomes that people might try and set out within the negotiated part of the GMRA. So what you see in that second row there is an example of setting out the outcomes that might be there. In this case, we're looking at kind of cash margin. It talks about cases where the rate kind of may be agreed between the parties outside of the GMRA. There's also cases where that's the case, but the language also starts to detail a fallback rate listed in the GMRA in case there isn't any agreement. We might also negotiate a position where there's actually a specification of the interest rate. That just gives you some of the examples of the different business outcomes that were identified. Now, within that, you've also got some variables. You've got some variables as to what the currencies might be, what the actual rate might be. So it's starting to say, well, these are what the outcomes might be, and this is what you need to think about. This is what might differ in respect of each particular GMRA that we are putting in place. And for those eagle-eyed amongst you, you'll see that in this case, we defined 7 variants of this particular clause. The 7th variant being a particularly important one, being the other clause, i.e. it doesn't fit within the 6 other buckets defined in terms of business outcomes. Why is this important? Well, this is really important because what we might do with things thereafter, when we've been able to come up with a standardized way of defining what the different variants are and what they mean and what the variables within them are, you know, and we might start to utilize that in terms of our downstream systems and what they do. Of course, there's nothing to stop parties, where appropriate, negotiating bespoke outcomes that may not be appropriate for the broader industry, or there may be very particular concerns that people are dealing with. Those may not be relevant or cause problems for downstream straight-through processing, etc. So there is a real value in understanding that this is outside of the defined variance within the clause taxonomy, as we call it. So that takes us through essentially the clause taxonomy. The clause library is then, you know, what we can think about in terms of the new agreements that we might put in place or amendments to existing agreements. You know, if we say that we've now enumerated what these business outcomes are, we're then in a fortunate position where we can say, well, you know, could we not have some model wording in order to be able to not differ in terms of the language you use and reduce our legal risk, and actually have more of a chance of automating and using data and systems in order to be more efficient in terms of what we do. So the clause library then lists out model wording that could be used for the particular variants that have been identified. This gives you a view, the scope of the project centered on the 2000 and the 2011 versions of the GMRA. As discussed, we have run this for an initial 10 clauses of the GMRA. I think it's fair to say, I mean, obviously there's some subjectivity in terms of how one might define, you know, what a particular clause is. But, you know, let's say that there's, let's say 50 clauses that could be defined. So there's probably about 40 clauses left in order to be able to complete you know, this work for the entirety of the GMRA. And just to let you know that there's a strategy paper that's currently being completed that is due to be released imminently, that will really detail the work that's been done and what, upon completion of this exercise for the entirety of the GMRA, really what that means for the industry as a whole. This starts to now facilitate some of that discussion. If we have a better understanding of the terms that impact our resource management, from capital, liquidity, collateral, and resources more generally, you know, that puts us in a very good scenario, as opposed to a lot of the details within our legacy portfolios of, you know, the terms and what they might mean being exposed, and we have a better chance of a standardized data representation of what they mean. The clause library and model wording means that, you know, we're moving to a space where, as well as the preprint that has been kind of, you know, validated, but also the bits that we've traditionally negotiated and had our own house style for, we've now got a model way of doing it where, you know, where we don't need variation or just different ways, elegant drafting that may differ from firm to firm can be reduced. And that really means that we have a better way of dealing with regulatory requirements because we have a more standardized terrain of what the language is. I'd like to think it would reduce the time to negotiate master agreement documentation, because upon deciding on the business outcome and the variant, there is already prepared a form of wording that is acceptable by the industry. And we can then start to build systems, as I mentioned, around, you know, once those variants have been identified, to be able to automate those particular pieces. And, you know, in terms of the technology that might empower our journey here, I think another useful piece to detail is on the negotiation side. You know, there is an increasing use of contract lifecycle management tools or negotiation platforms, essentially tools in which we can use to generate those first draft of our documents, and in some cases to be able to help manage the approvals process all the way through to digital signatures and execution. Those tools require a clause library. They require us to have this all set up in terms of what the outcomes might be, what the different fallbacks might be. And so really this is a very useful accelerator in order to be able to utilize those tools should firms wish to do so. And I guess just building on from the last presentation, it also is an important component if we do want to ensure that we take into account what the legal agreement says, the GMRA says, as part of our work more broadly within CDM. This really sets out some of the benefits that we had talked about, and shows you how the clause library that's built on the taxonomy really forms a central part of this and the move to a more digital world. And one particular thing that we wanted to talk about in terms of some of the work that's now being done and discussions is around the particular use case that this has in respect of assisting firms with respect to netting. Now, what you'll be aware of is the commissioning of legal opinions for this purpose, which, actually those have been recently provided for the 2022 year. I think those have just been provided last week. So in some cases, those legal opinions will detail particular wording that is required in order to be able to achieve a particular positive netting determination. There might be an amendment, for example, to the Act of Insolvency clause that is needed. At the moment, firms manage that. It's quite a testing way to be able to manage that. There's a very difficult task in terms of having to scour through those pretty lengthy and complex legal opinions, find the clauses that need to be amended. Of course, every legal opinion has a slightly different way of detailing what clause they mean. Well, if we've detailed the clause taxonomy, how to define clauses, that feels like something that we can start to add real value here. But furthermore, when you start to go through those legal opinions, in a lot of cases, we're making the same amendment. However, each law firm, each particular scenario, we've ended up just having a very different form in which we do it, but the substance is the same. So as you can probably see, it feels like the clause taxonomy and library really allows us to enhance our way in which we use these legal opinions today and make sure we get the right wording that we need within our GMRA documents. And if we just go to the next slide, there's just a slide that just really talks about this particular exercise. We've looked at a particular legal opinion for Japan and trying to identify the helpful integration between the clause taxonomy and library and the whole legal opinion management process. And I have to say, this is something that I think, given the very manual and burdensome way in which this is done today, I think presents a lot of opportunities for enhancement.
If you do have questions, then please feel free to reach out to myself or to Akbar directly. It remains for me to thank Akbar and to hand over to Godfrey to close today's event.
Thank you to everybody today who presented. The last presentation was really interesting because I remember going through the GMRA 95, which is many years ago, and I think we've come a long way in this field as well. Thank you for everybody who presented today. There's always too much to cover, of course, and so look at the pre-recorded briefings because there is some good material in there as well. Despite our ongoing efforts, and in particular the crucial role of the repo market that we play today in the market, there is a long way to go. And you should analyze the latest repo surveys, which remains at the moment the best source of information to look at the trends in the market. As you can see, and as was said previously, the volume is still increasing, and the way people work with each other has still, of course, the four main ways: direct, through electronic trading, voice broking, and tri-party. And on the next slide, you will see that the main chunk of business is still in government bonds. And on that point, I want to actually appeal to the regulators at large and the central banks and the authorities. Don't over-regulate, as we have seen in CSDR. It's not always easy, I understand, but please try to understand what's happening and then make crucial decisions. I'd ask me also to thank Richard for his good work in the more than 20 years we worked on this together. And so, as I said before, you can find these slides in the pack. Now, before I close, particularly in the light of the CCP debate, it should be clear to everybody that the repo market provides the daily protection to make sure that we can balance risks in the market. And I understand there is a new academic study coming out about the European capital markets being led by a number of big CEOs of our industry. And as long as I'm in this industry, and it's a long time, of course, we always have tried to improve and create more financial stability. But recent events have shown again that we should not take this for granted. We have to continue to work on this. So my message to all of us is educate, help new colleagues, help regulators to grasp the importance of this real economy product. And it can help for the next crisis that we're definitely going to get. So thanks again. Thank you for attending. The next meeting will be kindly sponsored by Clearstream Deutsche Börse as part of the GFF Summit on the 13th to the 15th of September in Luxembourg. So it rest me one thing to say thanks and welcome to the new elected committee. Thank you for those who left us. Thank you to the staff for putting these 2 hours together, and see you in September in Luxembourg. Thank you very much. Have a good day.